So good morning anyway. So welcome to the Stories live web event. If you don't know me, my name is Jon Davies. Today I'm going to be talking about making the cash flow. And I think this is one of the most important topics for any business owner, because you can have a good business, you can have a busy business, even have a profitable business, but still feel like there's never enough cash in the bank. And that's kind of stressful. It affects how you make decisions. Can you hear me? Okay. Okay. I'm told you can't see me, but you can see the presentation. So I'll live with that, and actually probably spare a lot of you the sight of my face. So sorry. Where was I anyway? So yeah, because you can have a good business, you can have a busy business, even a profitable business, but still feel like there's never enough kind of cash in the bank, and that's kind of stressful. It affects how you make decisions. It affects how you sleep. It affects whether you invest, whether you recruit, whether you grow, or sometimes kind of hesitate because you're just not sure. So today, what I want to do is kind of break cash flow down into plain English. So no jargon, no complicated spreadsheets, even I'm an accountant, and certainly no accountant waffle, I promise. And we're going to look at why profit and cash are different, where cash gets stuck, and what practical things you can do to improve it. And it'll last around about, as usual, about 45 minutes, plus some time for kind of Q&A. And we will be recording this. We'll send the recording out later as well. So who is this for? As always, these events are aimed at kind of owner-managed businesses doing strong 6 figures or 7 figures, who are ambitious, perhaps aiming for 7 figures within a few years, but certainly owners who want more profit, lower tax, and less stress. And that's as you know, we've done this series of webinars this year. So far this year, we've covered things like maximising 2026. We've covered pricing for profit. We've covered tax year reset. Looking forward, we've got things like next month, we've got reclaiming your time, and a number of others through the year, but all with this kind of theme for business owners in this kind of state. And in terms of this one, why this topic? Well, last month in Liverpool City Centre, we ran a business improvement summit. We had about 50 people in the room, and we asked them all, everyone there was a business owner, and we said, what keeps you awake at night? And there were 2 clear winners or clear losers, depending on your point of view. And the kind of second one was about not having enough time. And funny if next month, we're going to cover that in next month's event. But the top one by far was worrying about cash flow. So therefore, it just made sense to use this month's web event to kind of look at cash flow and how we can make things better. Because it is that big question, isn't it? I hear this a lot from people. The accounts have made a profit, but where's the money? And it is a very fair question. I had exactly this actually with a client last week. The profit had £100,000, but in the bank, think, that's funny because it definitely isn't sitting in my bank. And this is where we need to understand one of the kind of most important financial lessons in business, because profit is not cash. Profit's an accounting measure. It tells you whether the business has made more income than expenses over a period. But there is an art to a profit and loss account. There is some judgment in a profit and loss account. You get to choose some accounting policies. So, for example, how long do you depreciate your assets over? If you buy a new laptop, is it going to last 2 years, 5 years, or 10 years? And that changes the expense that hits the profit and loss account. The profit and loss account also doesn't include some things like repaying loans and the likes. But cash is a science. Cash is what is physically in the bank. There's no art to that. It's what's there. It's what it says on your statement right now, what it says on the app when you look on the phone. And the two are linked, of course, but they are not the same. And like I say, last week, I was with a client, turns over about £2 million, £100,000 profit, but struggling for cash. And the biggest difference were loans, and both kind of bank loans and also kind of hire purchase. Bought a few vans, and therefore they're quite kind of hefty kind of hire purchase payments, and also a loan. And with a loan, as an example, if there's a £5,000 repayment each month, £4,000 of that's capital and £1,000 of interest. only the £1,000 of interest is hitting the P&L. The other four is not, but it's still a cash expense. Because if you think back with the loan, when it came in, when you receive the loan, it doesn't go to the P&L, it goes onto your balance sheet. When you repay it, it's the balance sheet. The P&L sits there untouched other than the interest amount. So why does this matter? Because ultimately, kind of cash is what keeps the business alive. Profit matters because over the long term, you need a profitable business. But cash is what pays the wages and keeps the door open. Cash pays suppliers, cash pays VAT, PAYE, corporation tax. Cash pays you, and cash is what lets you sleep at night. And when cash is tight, everything feels harder. You kind of, let's say, you delay decisions. You have that kind of hesitation and what have you, pot of investment. You're worrying about tax bills, you're worrying about payroll, and you spend too much time checking the bank balance. And that almost kind of freezes you a bit, freezes your brain, your ability to act and make good business decisions. And that's not how a good business should feel. So, like I say, profit is not cash. Because profit can, let's say, be tied up in all sorts of places, going into all sorts of buckets, as the side shows. It can be tied up in unpaid invoices. It can be sitting in stock, effectively kind of sitting on a shelf in your warehouse. It can be in work you've done, but you have not yet invoiced. It can be used to buy equipment. It can be used to repay loans and also get swallowed up by tax payments. Or it can be taken out by you. Because obviously when you take money out as bills or drawings, they don't hit the P&L either. And of course, none of those things are wrong at all. But they can explain why a profitable business might not have much cash in the bank. And that's why looking only at profit and loss is dangerous. You need to look at cash as well. And for me personally, one of my kind of earliest business lessons as such as when I was at school, one of my dad's best friends had quite a sizable business that provided roof racks to one of the major car manufacturers. Sizable business, very profitable business, but the car manufacturer paid on, say, 90 days, quite long payment terms, but then actually didn't even pay on 90 days and was kind of 6 months after invoice and hadn't paid. And Media Technicolor went bust. And let's say on paper it was profitable, but there was no money. The materials need to be paid for, the staff need to be paid for. And when it actually went down, he said to the car manufacturer, he told them, you should have told us. And he's like, well, I have been for 6 months, but you haven't paid. But it's back to that thing, profitable business, but went bust. So, like I said, that kind of comes in as well, probably this simple example I've got here. Because if you make yourself a 10 grand, great. You might make a profit of 3 grand on that sale, which is even better. But before the customer pays you, you might have had to buy, let's say, materials, pay the wages, pay delivery costs, and cover overheads. There's profit on paper, but you've got no cash yet. And if the customer takes 60 days, takes 90 days, or even longer to pay, you're funding that sale. And when you multiply that across lots of customers and lots of jobs, suddenly a growing business can be profitable, but still constantly feeling kind of short of cash. And this is why we like to look at the cash flow cycle. And this is very much the time it takes to generate cash within your business. And the example I'll use here is a client of ours, fashion designer. They sell predominantly through the likes of Next and Very and ASOS and all that. And they have but the clothes are manufactured over in China. And what will happen is, for argument's sake, Next ring up, email, what have you, say, we'd like to put an order of £50,000. And on day one, they order the stock. Now, their supplier invoices in there, and they're on 30-day terms. So on day 30, they pay the supplier. It takes about 60 days to make the clothes and have them arrive in the UK. They go directly to, in this instance, Next. So on day 60, they arrive at Next. And on that date, my client can raise an invoice to Next. Next have 90-day payment terms. They are good payers, they pay on time. But what it means is that the cash comes in on day 150. And what that means is their cash flow cycle, to an extent, is 120 days. So it's the time between day 30 when they pay the supplier and day 150 when they get the money off Next. Now, And it's important for every business to kind of understand this gap between when you have to pay for what you are delivering, and whether that is wages, whether it's materials, or whatever it might be, and when you get paid. Now, this is quite a long one. Um, that doesn't mean it is wrong. It just means understanding it and be able to manage it. So in this instance, they can manage it through some invoicing over the suppliers, also some invoicing over the customer. But clearly, knowing it means they can manage it. And of course, if you look at this, it's kind of interesting. If you look at Next themselves, they have a negative cash flow cycle because on day 60, they've got the clothes and they're selling them. And generally speaking, they're not offering credits. On day 60, they're getting cash in on sales and they don't pay to day 150. So they've got, like I say, in a good way, a negative cash flow cycle. We spoke to somebody yesterday, similar. They sell online. And actually with them, the way their business model is, again, they actually pay their suppliers monthly and are actually making sales before they pay the suppliers. And by that, they receive cash before they pay the suppliers. So any cash flow cycle is manageable. Clearly, we'd all love to have one where we get paid before we do anything. That's kind of rare, but if you know how long it is, you can manage it. And we kind of talk here about the idea of the growing broke. I kind of alluded to a minute ago when kind of new sales are coming in, you're thinking this is great and what have you, but it is that thing of thinking we've made the sale kind of brilliant, but if the cash isn't arriving for months and you've got to pay the wages, the rent, the software, the suppliers, the VAT, and everything else, if you're growing quickly, this can become a problem because more sales often means more cash is needed to provide the sales, to buy the stock, to pay the wages. And if you don't plan for that, growth can make cash worse before it gets better. And like I said, that's what we mean when we talk about growing broke. Sales are going up, the team's busy. Everyone thinks the business is doing well, but the bank balance is really kind of under pressure. And it's kind of confusing because it feels like success from the outside, but the inside you're thinking, well, why are we working harder than ever and still feeling skint? We had again, an example a couple of years ago, and particularly during COVID, actually, this specific one actually became the on the face of it growing broke, in that a client of ours had a lot of vehicles for what they did. During COVID, they realised they could pivot. The day job as such wasn't happening, and therefore ordering stuff online, and therefore they actually became the main or the number one delivery provider to DHL or DPD, one of the big kind of overall delivery networks. They had a load of people out there delivering stuff every day. It was great, but again, the issue was that they were paying the drivers on a weekly basis and so on and so forth, and DHL were paying on 30 or 60 days. So it kind of exploded in terms of sales. It was brilliant, but actually it created, again, this kind of issue of paying people up front and we're getting paid on 30 or 60 days. And again, that was solved by kind of some finance that kind of covered that, was tied into exactly what they're doing and paying. It was quite specific and was brilliant. But like I say, woohoo, we've got this big contract. Oh, how do I fund it? Was kind of an issue. So where does cash get trapped? Well, there's lots of places where cash gets trapped, and the usual suspects are things like debtors. Excuse me. So debtors, stock, work in progress being obviously when you've done the work. So effectively, it's similar to stock. Stock is when is the materials you bought to sell. Work in progress, when you've done the work but haven't billed yet. Of course, bad margins. Because if you're not making the margin, stating the obvious is you can have profits and not have cash, but if you're not got any profits, you probably won't end up with any cash. So if your margins are bad, you lose cash. Of course, loan repayments, as I said earlier, that's one which people often miss when looking at a P&L, is forget the loan repayments because only the interest is going through the P&L. Of course, the tax itself. And some of it comes from kind of slow or kind of messy bookkeeping, because if the records aren't up to date, you don't know what's happening and you don't spot it. And the other one on here over on the left is actually director kind of drawings. We've had one recently where, due to circumstances out of their control, as in a wide macroeconomic, if you want to call it, but as in a issue, a client effectively kind of the work dried up. Again, much like in COVID, would have been very similar if you're in travel, hospitality, or many other industries. This is quite similar. This one, the work dried up, but they were still taking money out themselves because they needed to live. But of course, again, it was that thing of actually the work dried up. The good thing is they weren't incurring the costs. So the business wasn't actually making a loss, but of course, cash was dipping down because they needed money themselves. So how do we make it better? Well, there are a number of kind of practical levers that you can look at. Some of the big ones, and I will kind of go through some of these in more detail. Some of the biggies are better records, better customer terms, better debt chasing, better supplier terms, early payment discounts, direct debits, stock management, cash reserves, and financing. And I'm going to go through all of those in a kind of a moment. And the key is in talking through this today or listening to this today, you don't necessarily need to use all of these immediately. You might use all of them over time, but sometimes it's working out which is the one which have the most impact quickly, and then implementing that and adding more later. So the key is really to look at these that have the most impact in your business, because for one person it might be kind of debtor days, like getting your customers to pay quicker, but another, actually the bigger issue is the amount of stock that's sitting there, and we kind of see that quite a lot, of stock being an issue. So just have a drink. So let's start then with, move the slide on. Let's start with better records. And I'm an accountant, aren't I? Therefore, I'm going to say you have brilliant bookkeeping. But it sounds boring, but it is the kind of foundation, because you can't fix what you can't see. And if your bookkeeping is 2 months behind, you're looking behind you, looking at the rear view mirror, and it's not telling you, okay, what's the cash problem now, or how do I fix it? You need to know at any given time who does owe you money, when it's due, when it's coming in, who you owe money to, what tax is building up that's going to have a bill, 2, 3, 4, 5, 6, 7 months down the line. Obviously, what's in the bank, and probably, most business owners know what's in the bank at any given time, but it's kind of the other bits around it. And then by taking what's in the bank and knowing what's going out over the next 2 or 3 weeks, and what the kind of real profit is sitting behind that. And I think one of the other ones having the kind of the records as well is that is then, if you know broadly what your profit is each month or on the year to date, you have an idea of what tax you need to budget for. And we're sitting here in May, and it might be, year ends, let's say June, and therefore the tax bill isn't until next March. But if you know now that I'm 11 months into the year and I've got a profit of £100,000, for example, to use a nice round number for me to see my sums on, and the tax rate is corporation tax rate, because the sliding scale, but let's say the corporation tax is broadly 20%. I know I'm going to need £20,000 next March, so at least I should be thinking of putting that aside, ready for it, even if I don't have it all today. And the other one as well is being on top of it, is knowing what profits made, and therefore what you can afford to take as a dividend, rather than just blindly taking the money that causes a problem later. Because, like I say, without kind of good records, cash flow management is a bit of guesswork, and guesswork is never the greatest of strategies. So the next one is customer terms. So this is a big one, because a lot of businesses train their customers to pay slowly. This might be, firstly, the invoice going out late. So back to the bookkeeping, getting the invoices out as soon as possible. You've done the work, get the invoice out. Or, it might be you can send the invoice out before you've done the work, or deliver the goods, depending on your terms. But, the invoice goes out, but the payment terms aren't clear on it. Nobody chases it till it's already overdue. And then you feel awkward asking for the money. But basically, you've done the work, you've delivered the product, you've delivered the service, and you're entitled to be paid. So the thing about the terms is making the terms really clear, and to an extent, you get to choose. There are, and I've had a couple examples already. Sometimes if you are working with very large companies, sometimes they almost see it as they're doing you a favor, letting you sell to them, and they will tell you the terms, and then you can make a choice over whether that fits with you. But if you're working with other SMEs or the general public, you do to an extent get to choose. Um, if you want your invoice to be paid within 7 days, 14 days, 30 days, 6 days, 90 days, that is your choice. The key thing is to make it very clear when kind of making the sale, so everybody knows what is happening. And then also in making the sale and kind of any negotiating with the customer is just being clear: are you invoicing upfront? Do you invoice when the job's done? Like I say, what when the invoice goes out, how many days are on it? Can you ask for a deposit? Stage payments, if it's a project, you're doing a £10,000 project over, in simple terms, 10 months. Can you, charge, say £2,500 now, and then, £2,500 every few months, or when you hit kind of milestones on the work being done. And it's about making it kind of clear. And a small change here can make a big difference. I mean, going from 60-day terms to 30-day terms, stating the obvious, gets the money in a month earlier. And the key is you do agree it with your clients. You're not dropping it on anything. But I think what people sometimes get stuck in their head over, this is what everyone does, this is what I have to do. And if you think, when you look at people who you buy off, there are a lot of different payment terms, and sometimes when people you're buying broadly the same thing from, and therefore you do get a choice. We see. I mean, I can think of a client for who we're the finance function for. There are a lot of subcontractors, and subcontractors are quite large businesses, not individuals. And one of them, their invoices are payable on the date they arrive, which is quite tricky sometimes because, of course, if no one's around to process it and that, but fundamentally they're okay with it being the following day. One of the other people who are providing us exactly the same thing on 30-day terms, and we haven't actually quibbled over either. That's a choice from both parties, and we're happy with both. So that's the first one: is pick your terms, pick terms that suit you, but then just make it clear and agree with customers so everybody knows where they stand. Of course, when you've done that, chase debts properly. Hope isn't a credit control system. Sending an invoice and hoping the customer pays isn't enough. You need a process. Clearly, most of us are good people, and we pay our invoices on time. But some people are good people, but are just a bit skin and decide to push things back. So it's on us when we've raised invoices to, gently give a little nudge as appropriate. And like I say, having a process there that you follow. So it might be a reminder before the invoice is due, a reminder on the due date, a chase as soon as it's late, a phone call if needed, and kind of escalation process if it continues. And it's not about being aggressive or anything. It's polite, it's professional, it's consistent. It's one of the fun, isn't it? We're being British, we don't like to talk about money, and often when somebody owes us money, we feel more awkward because we're asking for it. But this is business. You've done the work, you deserve to be paid. And the key here is consistency, because businesses get paid first are often just the ones who ask first. Because if somebody is perhaps short of a few quid themselves and they're deciding, if you're getting in touch and saying, oh come on guys, you owe me some money, you probably get paid first. So don't let awkwardness cost you cash. And kind of ways of helping this includes, it says here on the slide, consider tools such as automated reminders or credit control software. If you're using, one of the main kind of cloud software, so Xero, QuickBooks, or what have you, they have automatic payments reminders in there. So you can set them up. You pick, when they go out, but you can set up so it will automatically email your customer, a day before the invoice is due, the day it's due, 7 days after, 40, whatever you choose. You get to write the emails as well. You can decide, how they want to be worded, but it will go out without you thinking. There are then more flashy tools, things like Chaser, which kind of add layers to that. But fundamentally, the standard thing of using your accounting software, which has the function in there to chase things automatically, is a good start. I think another one, if you feel awkward, the best thing is if you feel awkward, get someone else to do it. So I'll admit in our business, one of the team chases if somebody is overdue. So it's not me, because I'm kind of conscious that when you're providing a service and you have a relationship, you don't want to be the one saying, every now and then it's fine, because actually you can use that. Or come on, whatever. Come on, John, you owe us a few. You're a bit behind. You mind paying? But sometimes you actually want it to be somebody else who's not chased. So when we're doing the day to day and offering advice and meetings, you're not talking about outstanding invoices. So getting somebody else to do it's great. If you haven't got anyone else, what I did in this business is early days, when I didn't necessarily have anybody to chase our outstanding invoices, I made somebody up, and we still have our invoices come from an email address, billing@jondaviescounters.co.uk. The name on it, I just made up a name, Belinda Billing, just seemed to work. And Belinda chased our debts. Now, in reality, that was me. It wasn't like not Belinda at the weekends or anything like that, but it was me, but it meant it was a different person. And some people had lovely little chats with Belinda, to be honest. I didn't go overboard, and nearly everyone who ever had a chat with Belinda knows after the event, because I kind of joke about it. Actually, it was me. It was to an extent, it was that when the automated ones were going out, they weren't from me, they're from somebody else. But it just took away that kind of awkwardness. Like I say, Belinda didn't get involved that often anyway, but it just, like I say, it takes away that awkwardness, because I'm a hypocrite myself. I'm the accountant, but I feel awkward sometimes talking about being owed money. We've looked at customer terms. What about supplier terms? So moving the other side of the equation. So can you negotiate better terms with your suppliers? So if you're paying them in 14 days, but your customers are paying you in 60 days, you're funding a gap. Therefore, can you try and get them broadly the same? Like I say, preferably the supplier terms are longer than the customer terms, but that doesn't have to be the case, and often is not. But at least trying to get them more in line. Sometimes it is unavoidable, but sometimes there's room to negotiate. And like I say, when you're talking with your customers, there is room for negotiation sometimes. Because this is absolutely not about messing suppliers around. I'm not talking here about paying late, because your suppliers matter to you. Those relationships matter. You want the relationships to be strong. It's just about matching your cash outflows to your inflows and having a discussion. Because if you can improve your supplier terms without damaging your relationships, pay on time, it clearly just helps your cash flow. Early payment discounts. So this can work both ways. You might offer them to your customers, or take them when buying. So this is where the invoice will be £1,000, but if you pay within 7 days, it's 950, 980, whatever the figure might be. You can do it the other way around and actually kind of say, if you have the starting point as thousands, but it'll be more if you pay on a certain length of time. But certainly early payment discounts are very common. Clearly, you need to check the maths. So it needs to work for you. Clearly, the discount can't turn a profit into a loss, else it's not worth doing. But it may well be that to you, that I'm going to use that kind of £9,000 down to 950. A 5% discount might sound big, but if it gets you paid 60 days earlier, let's say, it might be worth it. Equally, if you take a supplier discount, if you have the spare cash, it is worth paying immediately to get the discount on offer. But kind of don't guess, kind of model it and have a look. And of course, this is very common in softwares where most subscription software, if you go to the pricing page, there'll be an annual price and a monthly price. And generally, the market norm, and we don't have to do market norms, we can do what we want. But in software, it's usually that if you pay up front, you only pay for 10 months. So if the software is £100 a month, you pay a whole year up front, you pay £1,000 rather than it would be £1,200 paying monthly. We in the early days, this firm, we'd offer that for a little while, where if you paid our fees up front, it was 10 months worth rather than paying 12. That was a nice little thing at the start. We don't offer it anymore. For our clients who took us up on it, we are going back a good few years now. We still allow them to do it. Those who took us up on it way back then. We don't offer it at the moment because actually now we're in as we become a growing business and so on and so forth, we'd rather have the full 12 months. But it was a nice one, and every now and then for a specific thing we do, it might crop up again. Certainly not kind of ruling it out. Then actually getting the cash in quicker. You've agreed the terms, you've perhaps done things about early payment discounts and what have you, but then direct debits or ways of physically getting the money in. And for some business, direct debits are a game changer because particularly if you've got regular customers or if you've got recurring services, direct debit just makes the cash more predictable. 95% of our clients are on direct debit. Most are paying us monthly, and therefore, the invoice gets raised and the direct debit gets drawn and the money drops in the bank without kind of thinking about. We use Go Cardless. I mean, there are other ones available. One thing we like about Go Cardless has a linkage with Xero. So if I raise an invoice in Xero, it automatically triggers a direct debit. When we first had Go Cardless, before the link was there, you raise an invoice and then you have to go Cardless to tell that will pull that money down. Whereas that linkage just makes things easy. Clearly, there is a fee, but it's worth it for the time it saves and B, the certainty of the cash going in. And I think allied to that, kind of other payment methods as well. So it might be PayPal, WorldPay, or what have you, Stripe. And of course, as well, offering as appropriate things like Klarna or Iwaka. I know with us in Xero, our accounting software, there is an option to add to all the invoices a credit card option, which is done via Stripe, and that automatically offers Klarna, so people can actually pay one of my invoices in 3 interest-free payments, and so on and so forth. And also, we actually quite recently added Iwaka Pay, which gives people the option to pay in 3 installments with no fee, or up to 12 installments where there is a fee, kind of as at their end, if you see what I mean. So I get paid up front and they're paying over 12 months. And we had our first client took us up on that like last month, where they'd come to us with a kind of quite a backlog, including overdue accounts and so on and so forth. So the initial fee to sort everything out was a reasonable amount, and they did do it through Iwaka Pay. And actually, sorry, I've missed the other half of that, of course, is the recurring payments as well. Because if you can, a great way of bringing cash in quicker is turning one-off payments into recurring subscription style invoices. And like I say, with us, some of our fees are a monthly amount because we are running a payroll every month or whatever that might be. But our year-end accounts are an annual fee paid in 12 payments by direct debit. And so forth, and most people is something that you might want to do to kind of bring the money in earlier and predictably monthly, some sort of subscription model. It might be kind of retainers, service plans, maintenance contracts, memberships. One of the big ones 10, 15 years ago, which probably got people thinking, was the Dollar Shave Club, because nobody probably thought before then that people pay subscription to get razor blades. I pay a monthly subscription to Naked Wines. They know they're getting money off me every month, and then every quarter they send me some wine, and so on and so forth. Whereas if I was just left to my own devices, I might just forget. And in that, buy wine in Tesco's or whatever it might be. But of course, they know they've got X pounds coming in every month from me, and it works quite nicely. Yeah, and I know someone with a waxing salon who does a membership model, and I think you can have as many treatments as you want, but as you said, there's only so many times you can actually come in, really. But it's that thing of actually people therefore don't go somewhere else, and if you are in a salon, I know a few salons have similar ideas. Those people on the subscription are treated like VIPs when they come in. You know, they might get champagne or something because it gets other customers saying, how come they're getting the champagne? And kind of moves people on, excuse me, like that. Cool. Stock and work in progress. This can be, can get me a slide. Mm-hmm. There we go. Stock and work in progress. Yeah. So stock is kind of cash in disguise. If you've got 100 grand of stock sitting on your shelves, that's 100 grand you can't use for anything else. And of course, if you're selling physical goods, you need stock, but it can drain a business if you've got too much of it. You need to manage it. Same with work in progress. If you've done the work and not been paid, you're funding the customer. So taking a look at what stock is slow moving and what stock is obsolete, what jobs have been invoiced, have been done but not invoiced, can be a really, really good thing. We have kind of like a music shop, and them stock, from day one. I mean, I think in the first time we ever met them, the biggest challenge is because when you're stocking expensive musical instruments, people who are buying them often want to play the actual instrument rather than order it online, and therefore they just have to have a lot of stock. That is a given, and therefore, again, a bit like the cash flow cycle earlier, at least by knowing it, they can manage it. And then cash reserves. I mean, having cash reserves, and I know, it's easy to say, you've got lots of money, cash is never a problem, but by budgeting and cleverly building up and having a buffer, it gives you that comfort and then allows you to plan. And it says on the side, cash reserves reduce stress and improve decisions, because if you're not worrying about the cash, you're not checking the bank balance every morning, you make better decisions on the business, you're not as stressed, you're not as tired. You get to take advantage of early payment discounts. And like I say, that thing of actually budgeting as well and putting money aside for VAT, PAYE, and corporation tax, perhaps having a separate account or accounts for that, where every month you look at your profit and loss, see what the profit is, and put 20% into the tax savings account. Same with VAT. For many businesses, yes, it might go up and down a bit, but broadly it's the same every quarter. You get a feel. Certainly PAYE, you kind of know quite quickly, and it is the reserve or the buffer you want does depend on the business. People have a different view, depending on your kind of appetite for it. We use as a starter for 10 when we model kind of 7 key numbers in many businesses. Our starter for 10 is basically the outstanding tax bills, including perhaps an estimate of corporation tax, but broadly the outstanding tax bills plus enough to cover 2 months' overheads. During COVID, one of our largest clients, who I do the best part of a day a week for, they service the travel business. They're not a travel business themselves, but clearly in COVID, that meant potentially weren't going to be many sales in the near future. We actually do a weekly cash flow forecast for them anyway. But the term cash day became a big thing. What's the day we'll run out of cash if we never make another sale? Now, they're a very prudent business, and they had, nearly a year's worth of overheads in the bank. And they still were making some sales during that time as well. But actually, at least kind of just knowing and having that reserve gave us certain comfort when something like COVID came totally out of the blue as well. And obviously, we hope there'll be nothing as extreme as that. But obviously, people over the last couple of years, and whether it's now with cost rising due to Iran, 3 or 4 years ago, Ukraine as well, we're quite taken back of how many of our clients had supplies that came via Ukraine. So, like I say, things do crop up. And of course, the last one is actually to get some financing. So there's nothing wrong with borrowing if it supports a sensible plan. That could be an overdraft, invoice financing, asset financing, or an old-fashioned loan. The problem is borrowing to hide a broken business model. If the business is fundamentally profitable and the cash gap is caused by timing, finance can help. Or the loan is to fund something for investment, that is good. But if it's borrowing because you've got poor margins, uncontrolled costs, bad debts, borrowing is just kind of delaying the pain and causing more pain further down the line. So the key is understanding the numbers first. And I won't go into, say, all the different types of financing. I'll kind of leave it at that. But yeah, it's certainly an option. And kind of what this kind of comes to us with us is so what we look at in many cases the 7 key numbers for business, and this is what we do in our clarity meetings, as we call them, or in our business diagnostic review. We look at the 7 key numbers in any business, and they are, the obvious along the bottom: sales, the gross profit percentage, the net profit, the business return, the sales per employee. But 2 of the 7 are about cash. One of them is cash days. That's effectively the cash flow cycle. So we look at how many days on average debtors pay, how many days on average it takes you to pay suppliers, how many days on average stock sits there, to work out the kind of the cash flow cycle, and also the cash target. And the cash target is that cash reserve, and we use as a starter for 10 the outstanding taxes plus 2 months worth of overheads. But the point is, of the 7 numbers we look at, 2 are about cash. And when we run one of those reviews, we kind of find, these ones, we look at each of these, we look at how small tweaks in each can make a big difference to profit. But we also, there's two outcomes when we do it, one of which is the improvement in profit, and one is the improvement in the cash balance. Because clearly, if we're playing with cash days, it's not the profit we're playing with, but it's bringing cash in. And like I say, small change in those can have a big impact. So increasing prices slightly, improving the gross margin, but yeah, tweaking your customer terms by 10 days, or reducing your stock levels, planning the tax earlier, and so on and so forth. They might be small individually, but put together, they can absolutely transform cash flow. And that's why we model those numbers, because sometimes the biggest opportunity is not where the owner kind of thinks it is. So that's kind of the idea of that. And then hopefully, because we had some technical issues earlier, but hopefully available is a cash flow improvement plan and a checklist. Now, there's a detailed checklist able to kind of download, but I'm just picking out on the slide a few of the big ones. The checklist has a few sections. It's got records, is your bookkeeping up to date, and so on and so forth. Customer terms, are you clear on those? Debt chasing, and some to tick off over your debt chasing procedures. Supplier terms, again, it's covering some of the stuff we've kind of gone through already, but with little questions to ask yourself. Stock and work in progress, tax and reserves, and forecasting about, do you actually forecast in the future? And I'll just pick the customer terms one. The question's got that little checklist. Are your payments clear? Do you invoice as soon as possible? Could you ask for deposits? Could you use stage payments? And could you shorten your payment terms? And like I said, at the high level on here, the idea is that we've just picked 6 out. Update of just to check kind of immediately for perhaps an immediate impact is firstly to take your bookkeepers up to date, but then reviewing your debtors. Is there anyone there right now who owes you money that a phone call or an email could bring cash in today? Then reviewing your payment terms, look at, is there any suppliers who actually you think, I think they'd be okay if I paid on 30 days rather than 14. Have you got any stock that's been sitting there for ages? Or if you're a service, if you've got any jobs you have completed and not invoiced yet? And again, I'll hold my hands up. We can be guilty of that sometimes. We kind of finish. Sometimes we have kind of one-off bits of work, and it's finished, and perhaps no one's flagged it to me or Meg, who looks after things, that actually we need to raise an invoice there. And then look at the next 13 weeks. What's happening? And again with that, I said no complicated spreadsheets earlier. You can do that in a spreadsheet, but if you're in things like Xero has some cash forecasting tools that are there, and it will use the due dates on your invoices in and out. And it also uses AI, or or have you, or certainly kind of looks backwards at what you've paid in the past to basically estimate what, oh, actually, we can see that you pay 30 grand in VAT every 90 days, it will drop in a similar amount. So it looks at some of your recurring things that might simply loan repayments. It looks at things that are not on an invoice, but it can see you've paid it every month, a loan repayment of 5 grand. So now I've got to drop that in there. So it's honestly, when they first dropped in, a couple of years ago, we weren't hugely impressed, but now it's pretty good. And what I say from there is then pick the biggest cash lever. What will have the biggest impact on you this week? And like I say, how we can help. Well, clearly, this is the kind of stuff we discuss with people all the time. And off the back of this, as we often do these things, is one of the things very happy to do with anyone who's on here today is to do a business diagnostic review where we look at those 7 key numbers we kind of outlined a few minutes ago, including the 2 cash ones, and kind of work through those and look at kind of levers to make things better. And there's I'll go to the next page. The QR code will remain on screen at all times, but the next page actually has the very long thing to type, but we'll send out a recording of this, and the link will be in there to ask to book one of those meetings if kind of useful. So on that was, like I said, apologies, we started coming late to the technical difficulties, but I broadly hit 45 minutes. So we'll just check whether there's any Q&A, and I'm relying on a bit of manual here due to the tech. So we've got, in the same way, manually things come in. Cool. Yeah, what's the quickest way to improve cash flow? Well, I guess going back to that slide a couple of slides ago, picking those 6 things, but for many businesses, the single quickest way, or the single way to bring a cash flow influx today, is to go through your debtors. And if anyone owes you money, pick up the phone. Or contacting whatever you're kind of comfortable, because when we look at many businesses, there are debts that have just been, I say, ignored. Have just been allowed to kind of linger on a little bit. And certainly, then kind of linked to that is moving forwards is making sure you just invoice faster or as quickly as possible. There is a system there for you, so invoices go out as soon as possible, and you make payment easy. I do think offering options of how people pay makes you reducing the friction for someone to pay you, and therefore they'll pay quicker. Like I say, it's relatively easy. We've used direct debits for a long time, and certainly if we go back to this firm's 9 years old, and we bought it in the previous firm, I know 3 or 4 years before that. But it's relatively recent. We've actually added Stripe onto our invoices, i.e. for credit card payment. But it's funny how many people have used that option. Who and like I say, we don't do lots of one-off work, but we do have a few small clients where we invoice once a year because it's a small amount, a few kind of personal tax returns and that, which are not our core business, but often it's the relative of a client or whatever it might be. And yeah, people just do that and do it straight away. So offering those options is always good. But it's that thing. Number one, a quick influx often is going through your debtors, but then moving forwards is being very, having that methodology, that process, but invoicing as quick as possible, make payment easy, and then perhaps chase earlier. A reminder the day before it's due, rather than wait till after it's overdue. So that's how often should I look at cash flow? Again, that is up to you. Like I say, have a client for whom we do a weekly cash. Actually, I think of a few actually, but what I'm involved with, it's every week. And I was going to say, ironically, they never struggle for cash, but perhaps that's why they never struggle for cash. the irony is, yeah, they actually have, they're the client who had, 12 months worth of overheads in the bank. So actually, they're never actually struggling for cash, but that weekly cash flow forecast, which to be fair predates my involvement as RFD, is probably part of why they've always had big reserves. Weekly for most businesses, in terms of obviously clearly looking at the bank and what's going in and out and know what's coming up and making your payments and chasing the debtors, weekly is good. Doing a more detailed look at the future, perhaps monthly or so. I think weekly for most businesses is perhaps over the top to forecast the future, but certainly weekly in terms of knowing what's going in and out in the next week, who you need to pay, and kind of what money's coming in, or of course, if any debts are overdue. Um, and then the last one I've got there is what if customers just won't pay faster? um, yeah, I guess some customers will always be difficult. As there's two steps actually. Is that it might be the question might be, what if my terms can't be quicker for customers? And I guess your terms you do get to choose, and you get to choose who you do business with. And if somebody refuses to pay on the terms you want, it might be you decide not to do business with them. If though you do want to do business, it's your business, you get to choose. And therefore, you might say for some people, I will allow longer terms. Let's say for us, as a general rule, all of our clients, it's a rule they must be on direct debit. We have a handful who are not. But I would argue that over the course of the business, the ones that have probably caused a problem are ones that don't like direct debits. And actually probably, sometimes there might be a reason for that because they know they're always running on empty and sometimes it might bounce. But, again, you kind of get to choose. But then in terms of those customers when they're on board about paying faster, I think that some people are difficult, but it's having the process. The terms are clear, you invoice immediately, you're chasing consistently. And as I said earlier, not being rude, being professional, being courteous, but actually just keeping that kind of going and knowing that it's working like clockwork. And if you do want to bring stuff in faster, you might consider, a deposit or something up front. I think for most things, we were talking to somebody yesterday who hires stuff out, and clearly they want a deposit before anything starts because they actually have to get the stuff ready for you to hire. So if you then cancel, it's an issue. But even just bringing in cash as soon as an order is made, even if the hire isn't happening till next week, next month, or what have you. So I think that's all of the questions I've got there for the moment. So let's say I hope that was useful. Like I say, if you'd like a profit diagnostic review, the QR code and so on is there, but simply we will send the link out afterwards. And as I said at the start, actually, and so there's the same QR code. It's not a different one. When we did the Business Improvement Summit last month, we asked like everyone what the things that keep you awake at night, and there were a number of things, but there were two absolute standouts. And the most popular or the least popular was cash flow. The other one was about time, not having enough time to do what needs to be done in the business, and then consequently not having enough time to do what you want to do outside of the business. So our next one of these events will be Reclaiming Your Time, and that will be at 10 a.m. on Wednesday, the 10th of June. So I very much hope to see you there, and thank you for joining me today. Cheers, and see you next time.